Hey, good day. It's time to wear those thinking money caps again and be adequately informed about everything related to businesses and money. We're Capitalist Domain, the best stop for all your business tips to always keep you ahead in the competition of life. Learning how to invest correctly is not for the average person. If it were, we'd see many people living the rat race and living their lives. It takes a lot of effort and patience to learn. And even if you understand the ins and outs of investing, you'd be surprised that you still know so little more often than not. It comes with risks, and there's no trial period when investing your money. It's either you go for it or you go broke. But we know that going broke is never an option. So we learn from experts and listen to what they say to avoid that. So here we look at 10 investing myths and see if any of these hold. We look at these myths from the perspective of Warren Buffett, CEO of Berkshire Hathaway, the 8th wealthiest man in the world, and one of the world's most successful and well-known investors. Stick around in the video and take notes when you can as we bust these investing myths and eventually apply them to our income-generating projects. Number 1. Hold cash and hold it tight. This doesn't literally mean that you should hold cash, but from a financial perspective, it means money that is available for a company or individual that they could spend on investments such as physical assets or for investors. In other words, this is cash not yet paid but is on hold for future purchases. The question here is, why should you hold cash? There are reasons why firms do this and depend on the motive. There are many reasons to keep cash on hand to deal with uncertainties, crises, cash shortages, and volatility in cash balances. Money is held for these reasons as a precaution. So is it wise to hold cash? Warren Buffett doesn't think so. He says holding too much cash for a long time isn't advisable and we should find ways to employ that money. Cash, when available, should be invested in good businesses according to Buffett. Number 2. Listen to the market. But in the words of Warren Buffett, you should listen to yourself. If you think a business is attractive or worth investing in, go ahead and invest. According to him, it would be foolish not to take the opportunity just because the market says so. We know that the market is malleable. However, if you know that business ins and outs and are sure that it's profitable, then the wise move would be just to go ahead and invest. Number 3. Put a lot of eggs in the basket. Diversification of funds is a concept investors teach early on and it has a lot of advantages. By diversifying your investments, you reduce the likelihood of your portfolio being wiped out by a single unfavorable event affecting a single holding. Instead, your portfolio is distributed over many asset classes and firms, protecting money while enhancing risk-adjusted returns. Let's say you diversify your portfolio to about 30 businesses. If you inject money on the 22nd instead of the business that gives you the most profit, it just shows you don't know what you're doing. Buffett says there's nothing wrong with diversifying your funds, but you don't have to invest in many businesses that give you little to no gain. Instead, what you should do, according to him, is to pick 2 to 3 firms that are very profitable and nurture those few eggs in the basket. That way, you're sure that your money is protected and the dividends you get from the few nurtured businesses will be enough to set you for life. Number 4. Don't risk it all. We've often been told that there are levels of risk when investing in your finances. There are many ways to determine this, however, according to Warren Buffett, past volatility is not a reliable measure of risk. In fact, there is no accurate measure of risk and it is hard to define precisely. The real risk, however, depends on the person investing. If you're not confident in the business you're trying to invest in, or if you don't know what you're getting into in the first place, then there is a higher risk of your investment failing. In short, the risk comes from not knowing what you're doing and it has nothing to do with the volatility of the prices. Number 5. You have to be a genius. Do you need a high IQ when learning how to invest? If you know how to get from one place to another, then you're just as capable as Albert Einstein or Elon Musk of making sound investments. It's not an intellectual quality that should be the basis, according to Warren. Your temperament should be more of a foundation because in any investment, a stable personality has more weight than an intellectual one. By a stable personality, he means that you shouldn't listen to others telling you that a financial decision is right or wrong just because they said so. You're right because the facts are present and because logic and reasoning tell you it is correct. Number 6. Find the best investment. Finding an excellent business you can invest in is undoubtedly challenging. But you don't have to look far and wide when finding the best investment because you're looking right at that person in front of the mirror. Warren says that the best investment is yourself. He said if you invest in yourself, nobody can take that away from you. Investing in oneself means having a good education, learning to communicate and socialize properly, and being generally healthy in mind and body. This is undoubtedly one tip we can all live by. This is excellent advice we should follow. Number 7. Listen to the experts in asset allocation. Warren had to reiterate this over and over in a talk wherein he was asked how people should allocate assets. He says that all people have an economic incentive. Say you have 60% in stock and 40% in bonds, and a financial advisor would tell you to make it 65 to 35% and make it seem like there is a problem with allocating your assets. The problem, he says, is not with you but with the people trying to sell you their services and making you think that you don't know what you're doing. He advises sticking to your default position. If you see an excellent opportunity, you can take it. You don't need experts in investing. Number 8. Go and day trade. This next myth may be controversial for those in the trading business, but hear us out. According to Warren Buffett, day trading is something almost considered gambling. And gambling is a thing most people have a propensity to do, whether legal or illegal. In this case, he says that gambling is a tax on ignorance. These are practices that the government condones since it brings much revenue to them, much to the chagrin of the regular people. So don't put yourself in the trap of legal or illegal gambling. Instead, focus on good money-making practices. Number 9. Growth and value stocks. Wall Street experts would tell you that growth stocks and value stocks are contrasting things. Warren likes to think otherwise and says that there is no distinction between one or the other. The only significant difference between the two is that a growth investment was usually created more recently and hasn't yet realized its full potential. On the other hand, a value investment would typically be an established firm that was undervalued or had fallen on hard times. In terms of gains, that's entirely debatable since many investors believe that value stocks would have greater returns than growth stocks. However, Warren doesn't want you to think of these two stocks as separate entities. Instead, they are considered the same. Number 10. You need lots of cash. We can all relate to this last myth, and I'm sure we've all had that thinking that to be successful, we need lots of cash. But according to Warren Buffett, cash is just like oxygen. It's always there and you'd never run out of it. Sure, it will go down in value over time, but just like an oxygen, you only need a certain amount and any excesses would just be useless. So the way to look at this is just to ensure that you constantly have cash around like oxygen and that you never run out. That's it for today's informative video. Warren Buffett's perspectives can't only be applied to our business and financial lives, but we can also use this to our personal lives. Success doesn't mean you have all these growing businesses and lots of money to spend and earn. It means being content with what you have and making sure you have peace of mind for yourself and your family. If you like this video, click that thumbs up and subscribe. This is Capitalist Domain and we'll see you again next time for more helpful tips.